Okay, so you want to own a car wash. You've already watched this happen. Think about your normal drive, the road you take to work, or to the grocery store. 3 years ago, there was maybe one car wash on it. Today, there are 4, maybe 5. They went up fast, they all look roughly the same, and every one of them has a sign out front offering unlimited washes for about $30 a month. That looks like a boom. A whole industry deciding, all at once, that your town needed more places to clean a car. Except in February of last year, one of the largest chains in the country, 260 locations, 625,000 paying customers, filed for Chapter 11 bankruptcy. Around the same time, one of the biggest corporations in the business took an $851 million write-down and then sold its entire American car wash division and walked away. And this past May, the largest car wash company in America stopped being a public company at all. All of that happened while the buildings were still going up. By the end of this video, you'll understand the margin number the entire industry quotes that isn't actually true, and what the real one is. You'll understand why the wash itself is almost free to produce, and why that changes everything. You'll understand the single statistic, 79%, that proves these places aren't really car washes at all. And you'll understand what happens to a $4 million building with a tunnel through the middle of it when the money stops. Because that's the part nobody planned for. These things are almost impossible to turn into anything else. Let's start with what it costs to put one on a corner. A full express tunnel, land, site work, building, equipment, runs somewhere between about $3.85 million and $10 million, depending on the market. The tunnel equipment alone is $1 to $3 million. The land is a few $100,000 more. You need roughly an acre and a half on a road with heavy traffic. On the side, people drive home on. And once it's built, the thing that makes it remarkable is what isn't there. People. The car wash you remember from childhood was a full-service wash. Guys with towels, vacuuming the interior, wiping down the dash, a line of people working the exit lane. In that model, labor ate 40 to 50% of revenue. Every dollar that came in, half of it walked back out the door in wages. The express model deleted that. A modern express tunnel has a conveyor, an automatic pay station, and roughly a dozen employees total across all shifts. You stay in your car. The whole thing takes 3 to 5 minutes, and then you pull into a bay of free vacuums and clean your own interior, which is the part people think is generosity and isn't. The vacuums are free because they give you a reason to come back, and because you doing the vacuuming is cheaper than paying someone to do it. Labor drops from roughly half of revenue to around 15%. There's a second thing hiding in the tunnel, and the industry loves to talk about it. Water. A modern express wash recycles most of what it uses. Reclamation systems capture the runoff, filter it, and send it back through. So the actual fresh water introduced per car can be under 15 gallons. The trade association will happily tell you that's less water than you'd use washing the car in your own driveway. It's a real efficiency, and it's also a marketing line produced by the people who sell the equipment, so hold both of those thoughts at once. What matters for the economics is simple. The marginal cost of running one more car through the tunnel is almost nothing. Which brings us to the number you'll hear everywhere. Ask a broker or an equipment vendor what an express car wash earns, and they'll tell you 40 to 50% EBIT-DA. Half of every dollar, straight to the bottom line. Here's the check on that. Mr. Car Wash is the largest operator in America, with 549 locations, and until 2 months ago, it was publicly traded, which means it had to tell the truth in writing. In its 2025 fiscal year, it crossed $1 billion in revenue for the first time. Its adjusted EBIT-DA margin was 32.8%. Not 50. 33. That's still an outstanding margin, better than almost any retail business in the country, but the gap matters, and it's worth knowing where it goes. Corporate overhead, interest on debt, and the drag of new locations that haven't filled up yet. The 40 to 50% number describes one mature, busy tunnel on a good corner. It is not what happens when you own 500 of them. But here's the thing, none of that, not the equipment, not the labor, not the margin, is actually the business. Because look at where the money comes from. At Mr. Car Wash, in the fourth quarter of 2025, 79% of wash sales came from members of its Unlimited Wash Club. Not from people pulling in and paying for a wash, from people paying a flat monthly fee whether they show up or not. In 2015, that number was 30%. It has climbed every single year since. 79%, roughly 2.5 million people on monthly subscriptions. That is not a car wash company. That's a subscription company that happens to own tunnels. And once you see it that way, every design choice makes sense. Start with the camera at the entrance. Most express washes now use license plate recognition. You pull in, the camera reads your plate, the gate opens. You don't take out a wallet, you don't tap a card, you don't make a decision. Your license plate is your membership card, and the single most important thing that system does is remove the moment where you'd think about whether this wash is worth $8. Then look at how often members actually use it. The company's own filing said the average member washed more than 30 times in 2020, about 2.5 times a month. Independent data from a car wash software company drawn from more than 2,000 locations put it at 2.3 to 2.6 washes per member per month. So a member paying around $30 washes their car roughly 2.5 times, which sounds like they're breaking even. But the actual cost of running one car through a tunnel is water, soap, and electricity, $1 or $2. Everything above that is margin, and they'll sell you up. The base membership gets you clean, but there's always a tier above it. Hot wax, then ceramic, then something called graphene, each a few dollars more a month, each costing the operator almost nothing to add. And in a rainy month, when nobody washes anything, the payment still comes out on the first. It's the gym membership, applied to a driveway, and the executives talk about it in exactly those terms. The company's CEO, John Lai, put it this way on an earnings call, quote, "Once you get used to having your car clean all the time, and then having to pay as you go, you really miss it." His chief financial officer described tracking what he called member utilization, the industry's actual term for how much of the thing you're paying for you actually bother to use. What that model did was take a business that was completely at the mercy of weather and impulse and turn it into predictable, recurring, monthly revenue. A rainy week used to be a disaster. Now it's just a week where the machines run less. And that transformation is exactly why the corner's filled up. Because recurring revenue doesn't get valued like a car wash. It gets valued like a software company. Private equity noticed, and the money arrived all at once. In 2021, roughly 936 new car wash sites were built in the United States. In 2022, 943. That figure comes from the head of the industry's own trade association. And in its bankruptcy filing, the chain that failed described the same thing in its own words. Upwards of 900 new car wash sites opening annually across the country for 5 straight years. Nobody was building for the demand that existed. They were building for the subscribers they expected to sign up. Then interest rates went up and the arithmetic broke. The chain that filed in February of last year was called Zips. 260 locations, 625,000 members, generating about 2/3 of its revenue, and $653.9 million of debt against roughly $1 million of cash. Read that again. A company with 600,000 people paying it every month could not service its debt. The subscription model worked exactly as designed. The money came in, predictable and recurring, month after month. What broke was everything built on top of it. Private equity had loaded the company with debt on the assumption that the subscriber base would keep growing forever, and when rates rose and growth slowed, The same recurring revenue that made the business attractive simply wasn't enough to cover what had been borrowed against it. And the corporate giant, driven brands, wrote down $851 million of car wash goodwill in a single quarter in 2023, took another $325 million write-down the following year, halted all new construction, and eventually sold its entire American car wash business for $385 million, a fraction of what it had paid to build it. Meanwhile, the town started pushing back. In Warren, Michigan, officials counted 25 car washes inside 35 square miles, 6 of them within a single mile of one road, and passed an 8-month freeze on new ones. A councilman in Perrysburg, Ohio, put the concern plainly. Quote, "If you build a flock of them, inevitably one or more will fail, and you're left with an eyesore that is not easily devoted to another use," which is the whole problem with the building. A tunnel is a tunnel. You can turn a closed restaurant into a different restaurant. It is very hard to turn a car wash into anything. So what's actually being bought and sold here? The answer is the same one this channel keeps arriving at. Listen to how Mr. Car Wash's chief financial officer described funding the company's growth. Quote, "Sale leasebacks remain the most attractive source of capital for Mr. We are targeting proceeds of $40 million to $50 million a year. A sale leaseback means selling the land and the building to an investor and immediately renting it back so you can keep operating on top of it. Car wash properties have been trading at cap rates around 6.2%, on leases averaging close to 20 years. The operator keeps the subscribers, the investor keeps the corner, and the corner is the part that holds its value, no matter what happens to the wash. So, should you own one? The honest answer is that the business is genuinely good and the timing is genuinely hard. A well-located express tunnel with a large membership base is one of the better small businesses in America. Low labor, recurring revenue, high margin on every additional car. That's real. It's why the money came. But you would not be opening into an empty market anymore. You'd be opening across the street from a chain that has 500 locations, 2.5 million people already subscribed, and a camera that recognizes their license plates. Your competition isn't the wash next door. It's the fact that your customer already pays somebody else every month, automatically, and has stopped thinking about it. A membership you never cancel is the most valuable customer in retail, and the chain signed up 2.5 million of them while the corners were still under construction. To win one back, you don't have to be a little better. You have to be enough better that somebody reopens an app they've forgotten they're paying. And here's the last detail. This past May, Mr. Car Wash was taken private by the investment firm that had owned it before, a $3.1 billion deal at $7 a share, which means the most detailed public accounting anyone has of how this industry actually works just went dark. 2025 is the last year we get to see the real numbers. The tunnels are still going up. We just don't get to look inside the books anymore. If this changed the way you look at the one you drive past every morning, subscribe. We take apart one everyday business every week, and the numbers are never what you guess.